Welcome to Investors Insights. Our topic today is romance with inflation. We thought that topic was appropriate for many reasons, and you'll find out from the data we're going to share with you today. We also took in consideration that tomorrow's Valentine's Day. And so we hope everybody is going to have a great Valentine's Day. Make sure you get those flowers and the candy and all the fun things for Valentine's to have a great week. We also, from the standpoint, know that those things are going to cost more. And so you're going to hear topics this morning about inflation, about budget. We're even going to talk about the Super Bowl. So with that in mind, I have my distinguished colleagues with me. Bobby Norman, Senior Vice President, Managing Director. I have Trey Booth, our Chief Investment Officer and Senior Vice President. And Ty Miller, our Associate Vice President, who's on the portfolio strategy team with Bobby, Trey, and me. You know, guys, for somebody who watched the Super Bowl last night, you were really alert this morning and came in, with data just firing left and right. Bobby, you started off, just had to point out to us about inflation and used cars and gas prices. So you want to elaborate on that?
Yeah, Greg, the market moving event this week could be when the Consumer Price Index report comes out on Tuesday. And expectations are that the annual price growth decelerated to 6.2% in January, but the core CPI, which takes out the more volatile food and energy numbers and is usually seen as a better measure, is projected to rise 0.4% month over month, which is not what the market or the Federal Reserve wants to see. And you can see on the right-hand side of this chart that core CPI has started to come down at the end of last year, especially inflation of core goods. So the market has started the year strong on the thought that inflation's coming down. So a hotter inflation number could reverse the trend down in the market. And we're concerned about Tuesday's report because we're seeing a rise in gas and used car prices. As you can see in this chart, used car prices have surprisingly come up in recent weeks, which was unexpected, and still remain well above the historical prices in this chart going back to 2008. Again, that's a big jump since 2008. So Tuesday's inflation report is very important because trading sessions and market trends were negatively impacted throughout last year on days when CPI was reported. And with the much stronger than expected jobs report we saw 2 weeks ago, a higher inflation number could do damage to the market for a few weeks.
Yeah, that's all great insight, and we still have a lot to navigate through this year. A lot of contradictory scenarios going on, and I thought you really made some good points there. And then Trey, a big topic that we've already been talking about this year is in terms of the government and budget. And, you elaborated today, gave some good insight that Congress may be in for some surprises here. That some of our congressional leaders may not be aware of, but our viewership and our clients will be. So talk about that.
Yeah, absolutely, Greg. So what is typically a ho-hum event, the Congressional Budget Office updating their official budget baseline is going to be market moving data. It comes out on February 15th. And why does this budget baseline matter? Well, this is the number that Congress uses when they're considering bills or changes to the deficit, changes to spending. They use this CBO baseline, the Congressional Budget Baseline, as a guidepost on where things are going. And this number has been updated since May. You think, well, May's not that long ago. Well, a lot has happened since May. The current Congressional Budget Office baseline is using a 1% Fed funds rate. Currently, Fed funds rate are 4.75%. So to put that in context, that's an additional $300 billion in interest payments that have to be built into the going forward budget. That's $300 billion that Congress, when they're dealing with this debt ceiling debate, have to take off the table for spending and have to use for interest. In addition, this chart shows that spending overall is up $570 billion above the baseline estimate. Again, another dollar figure that means that Congress has to pull that spending off because it's already been accounted for. And tax revenues are relatively flat, so not a big tax windfall expected. So what does all this add up to? This means that the deal over the debt ceiling was expected to last all the way until July. That's when Congress was going to have to deal with this. And we all know
take care of it.
Yeah, Congress never acts until they have to. They're going to talk in the media. They're going to go back and forth. The increase in the spending is going to pull that timeline forward by as many as 2 or 3 months. So Congress thought that they had as many as 5 months to deal with this. they really only have maybe 8 to 6 weeks. That's a much shorter timeline to get a bill passed. And so that's going to pull forward the market volatility. This is important for markets. In 2011, the S&P was down 15% during this fight. Markets have definitely been a little bit more, they've ignored it a little bit more than it did then. But that's because markets don't react until we see the whites of their eyes. And so this pulls forward that volatility date to somewhere maybe in May or as early as late April. So a lot to look at, a lot coming out on that February 15th baseline data that we're going to be digging into and reacting to as needed.
Yeah, a great summary there. And I want to point out to our viewership from the standpoint, already this year, I've been sending out letters and emails to clients, keeping them updated. You also, in our Investors Insights meeting that we had here, as well as the virtual meeting, Trey, you pointed out some of these topics in relation to budget, and that the news media may make a big deal about it. They focus on some of the wrong things, and that's why we give this kind of information to keep our clients ahead of the game to understand what they need to focus on. And we're going to continue delivering that kind of information, not only like this, in-person meetings, phone calls, but also on our social media, LinkedIn, Twitter, YouTube, the podcast, Facebook. We're going to continue giving this information. And then Ty, I really, all these years with me being in the business and hearing data about Super Bowls, I thought you did a great one. So regardless of whether you were for the Chiefs or the Eagles, if you're in the markets, you may be okay overall in the long run with the outcome. Is that correct?
Yeah, that's right. So it was a great game last night. Congratulations to our Kansas City Chief fans. I feel for you, our Philadelphia Eagle fans. However, there's been, according to this chart, there's been 8 instances where the city of Philadelphia has won a World Series or Super Bowl since 1910. And every time that Philadelphia has won one of those events, it's been followed by some kind of event that has been negative for the market. Crash in 1929, Great Depression, financial crisis. These are big things. And of course, purely, coincidental. It's nothing that, we trade off of here or anything, but I feel better showing you.
Yes.
Feel better showing you this today than it had the Eagles won last night. I would say that.
Yeah. We like to have a little fun here at Five Plan, and because we are data hogs and we nerd out, we just like this for fun. So I thought that was great that you showed that.
Yeah.
And I think you also had another great chart for us.
Yeah, on a more, serious note, on a seasonality technical note, the latter half of February is typically a little weaker, as you can see in this chart. Usually starts around the 15th of February, which of course is coming up this week. We see some weakness for a couple of weeks until the end of February. And as you can see on the, this next chart here, February is the second worst month of the year typically. Of course, September is the worst, which is my birthday, another coincidental thing that I wouldn't trade off of.
We can highlight that to you, though.
But it's followed by a very strong March, typically. Again, this is all seasonality. And we're also in the midst of the strongest quarter of the 4-year presidential term. So while, the next couple of weeks could see some volatility, it's not the end of the road here. Seasonality says that we should perk back up here in March.
So, folks, a lot of information this morning, a lot of insight. You get to see how we're looking at the data as it's coming at us and projecting out, how that will impact your portfolios in relation to your financial blueprint. Just know that every day here, we're striving to make our clients' lives better, richer, fuller. And it's this kind of information, the amount that we spend and analyze on research, our time, the money, we want to make a difference for you. We hope you have a great week. If you can have a great Valentine's, that's great. But regardless, just know we're crazy about you here at Five Plan Partners. Talk soon. Thanks.